Some balance sheets are pulled between two opposing financial forces, making them nearly impossible to value with a single ruler. Kolon Industries, ticker 120110, currently trades around 59,400 won. Viewed through the lens of earnings power, the stock trades at an 85% premium to fundamental value, leaving investors no margin of safety. However, a valuation based on net assets tells the opposite story. The stock is priced at a 50% discount to its book value. These two realities create a massive valuation gap. For the stock price to stabilize, one of these models must eventually give way to the other. We are going to build both models head-to-head to determine what the market is actually buying at 59,400 won. To start, we have to look at what Kolon actually produces: high-barrier industrial materials that are essential to global infrastructure. This tire cross-section shows the technical fibers embedded in the rubber to provide structural integrity. Kolon is a primary supplier of these reinforcing materials. They also manufacture aramid, a specialized superfiber used in everything from ballistic armor to hybrid tire cords. These materials require years of safety certifications, creating a volume moat. Once a client like Michelin or Goodyear approves a material, the supplier relationship is difficult to break. The data shows this moat is intact. Domestic market share is climbing, and aramid factory utilization is pushing past 80%. But there is a structural weakness here. Kolon has a moat for volume, but they lack a moat for pricing. Because of massive supply expansions from competitors in China, Kolon must accept market rates for their materials, regardless of their own production costs. This chart shows the result. In 2025, while market share and volume rose, operating margins collapsed from 4.1% to just 1.1%. Running factories at full capacity offers little benefit if the company cannot control the final selling price of its goods. Let's apply the earnings ruler first to see how much cash actually belongs to common shareholders. Our model assumes a normalized operating profit of 190 billion won for 2026. Before reaching common investors, the capital structure must be serviced. The primary drain is 447.2 billion won in perpetual bonds. These require 29 billion in annual interest, which, with preferred dividends, creates a fixed 32.7 billion won deduction every year. In a low-margin environment, these fixed costs act as a massive weight on the bottom line. After these deductions, the net income available to common shareholders shrinks to an estimated 92.5 billion won. If we apply a standard 11.9 times earnings multiple to that 92.5 billion won, the fair value of the stock is approximately 32,000 won. This suggests the current market price of 59,400 won is nearly double the value justified by the company's earnings power. To justify the current market price through earnings alone, net income would need to reach 180 billion won, a figure that exceeds even our most optimistic bull case projections by more than 20%. Purely on an operational basis, the current stock price has no support from earnings. If the earnings are so thin, why is the market paying 59,400 won? The answer lies in the asset model. On the surface, the debt is substantial. Kolon carries 2.2 trillion won in net debt. However, the company holds significant non-operating assets that are completely detached from its manufacturing business. These assets include major equity stakes in two of South Korea's largest financial groups. Kolon owns a 2.09% stake in Woori Financial Group, valued at approximately 490.6 billion won. They also hold a 1.52% stake in Hana Financial Group, worth 451.9 billion won. Combined, these two liquid banking stakes are worth 942.5 billion won, accounting for more than half of Kolon's entire common market capitalization. When we add 612 billion won in investment real estate and 328 billion in other equity, the total non-operating asset pool effectively neutralizes the company's entire debt load. With the debt covered by these external assets, the implied value of the core business is closer to 120,000 won per share. At 59,400 won, the market is buying a portfolio of liquid financial assets at roughly half their recorded value. We have two rulers telling two stories: a stock that is expensive based on profit, but cheap based on property. This creates a value trap. Hidden assets only matter to shareholders if management is willing to sell them or return that capital. Until a sale or distribution occurs, the market will likely continue to apply a deep discount to the stock's book value. There are 3 specific catalysts that could force the stock price to reflect its asset value. The first is the August 18th earnings release, where investors will look for evidence that operating margins can stay above 4%. The second is the September 9th deadline for the sale of the PCB and display units to private equity. A successful sale would inject 200 billion won in cash, directly reducing debt and the interest payments that currently consume the company's net income. The final trigger would be any plan to monetize the 940 billion won in banking stakes and return that value to shareholders. Without these triggers, the stock remains suspended between its 2 contradictory valuations. For institutional investors, the story of Kolon Industries is not found in its manufacturing volume. Turnaround stories and potential growth in AI materials are secondary to the structural 32 billion won deduction required to service the perpetual bonds. The company's valuation floor depends entirely on whether management decides to unlock the latent value of its non-operating assets. Kolon Industries functions as a specific arbitrage case, caught between its low-margin operations and the significant pool of hidden assets on its balance sheet.